So first of all, thank you very much for the opportunity to speak here today. Already, I was thinking before the event, what a great event. This is exactly my topic, my background. I will be surprised if I learn anything new. And what a surprise, I did learn quite a lot. So so welcome. My name is Matthias. I'm a founding partner of Rethink Mobility. I don't want to say too much about Rethink Mobility, and I don't want to speak too much about myself, but very much share with you my background so that you see that the event here is very much to the core of what I've been doing over the course of the past 15 years. After taking over my parents' companies and selling it after a couple of years, I had a long career, classic corporate career around innovation, around business incubation, about technology, then M&A, and then I had also the privilege to set up or help set up a corporate VC at Siemens. So it was a transition of Siemens Venture Capital into a fund called Next 47. It's a 1 billion fund that invests globally in startups, and I led the mobility and logistics practice there. So why am I saying that? Because two things have been running through my professional career over the course of the past 15 years, and that is two streams that are often very separate, but they increasingly come together, which I think is great. Investing in startups, venture capital. People do that usually with a finance background. And then you have the collaboration with startups. People usually with a background in innovation, technology, what's the future of our company? And these two worlds barely ever come together. So they have been separate in the past, and I think we've seen that quite a number of times. Robert Bosch showed how they moved from venture capital to venture client, trying to align those two. So I think this is something that resonates with a lot of with a lot of you guys. So I know both sides, and I've also tried to get these two sides merged together. How do you collaborate with startups? How do you get, as a corporate, meaningful value from collaboration with startups? How do you extract meaningful strategic value from investments in startups? How do you make money with investments? So this is all, there have been a lot of sharing of experience around that, and I want to share with you some more experience around that as well. So what we do, we are a fund. So quite legally, we are a classic, very conservative venture capital fund based in Munich. What separates us from most other venture capital funds is that we have a clear vertical focus. So we do not follow AI or robotics or some mega trend. We have a vertical focus. We go into the transportation of people and goods. So what does that mean? That means that we are not so much looking across sectors, we look at a specific sector. That also means that whereas a venture capital fund usually looks horizontally at all the startups that are currently out there for funding, we look vertically at all the startups that are out there. And if we do our job properly, we speak to the startups once they're founded. We speak to them, we talk to them, we know them, we get to know them before they seek funding. And when they then say, no, we don't need external money, we're good. And when they change their minds and we know it's a good team, then we are there to invest before everyone else knows about them. So that's our ambition. So we have a clear vertical focus. There is an advantage to that from an investment perspective. There's also an advantage from an LP perspective. So our LPs come into the fund because they have an interest in the startups, not necessarily because they want to invest in the fund, but because they seek an instrument to gain strategic access and meaningful access to relevant startups out there. And that is only possible if the fund looks at a vertical that is of relevance to the LP. So if you're investing in, or if you're looking at e-commerce, yeah, and you say, I want to find out about the Latin American market for e-commerce, and I tell you about mobility startups in Europe, we won't have much of a discussion. So what we seek here is LPs that have the same vertical focus that we have. So there's a clear sector focus. That's an advantage on the investment side. It's also an advantage on the LP side. Secondly, we leverage this advantage via a platform. So how do usually VCs work? And none of the VCs here today, of course, do that, only all the others. Usually a VC calls the LP once a quarter and tells him or her, look, these are the fantastic startups we see. These are the ones that we have invested in, and look at the traction, look at the scalability, great investment. The LP, the corporate LP, often has the perspective of, I want to talk about technology. I want to find out about innovation. I don't care about scalability. I want to find out where's a new business model out there. And will that be, is there a new competitor out there? Is there a new technology out there that might be of help to me? So there is this level of communication which is often not aligned between a fund that usually is financially oriented and an LP that may have a strategic interest. Yeah? So not every fund speaks corporate. That's very important. So what we do here is we facilitate a platform where our startups gain access to corporates they can collaborate with. It's not about the investment. It's an investment plus collaboration. So our portfolio companies, they can not only get the funding from us, but they can get access to corporates that help them. So that's the one thing. Then, secondly, the other direction, the corporates in our fund get access to startups they want to collaborate with. So it works both ways. So the next pillar for us is sustainability. It hasn't been much of a topic here today and yesterday, and I was quite surprised, to be honest. It's something which gains tremendous traction also in the venture capital field. We see that fund-of-fund investors, our investors, increasingly seek how you actually do sustainable investments. Up until very recently, it was enough to claim sustainability is very important. Sustainability is on the top of our minds. And then you do the stuff you've always done, the way you've always done it, investments. Now, the big fund-of-fund investors increasingly want to see specifically how you measure the sustainable dimension of your investment, how you do the incentive scheme of investments. Is the fund management incentivized by reaching or in line with reaching sustainability targets or not? So there's an increasing pressure. On the corporate side, we see that there are reporting requirements coming up, looming at the horizon, mid-2023-24. Something like the EU taxonomy will be up there, and corporates start to realize there's a whole new reporting requirement. So that's sustainability. And then, of course, we are still, with all the corporates I've mentioned, we're still a fund that is very much entrepreneurial. That means we are able to do quick and independent investment decisions. And if we do our job properly, we combine the strength of a venture capital fund, quick investment decisions, independent investment decisions, with the depth and technology know-how and market understanding of a strategic investor. So that's what we're trying to combine. So what does that mean for a corporate? So for a corporate, our approach is that we want to provide a financial return that you can expect from a very good generalist VC fund. That's where most of our team comes from. So you do investments, you do strong financial investments, and you have a great financial return. Our ambition is to combine that with the innovation return that you would usually get from a accelerator program. And I would by no means imply here that generalist funds don't make sense. Absolutely. Accelerators, good accelerators make sense. So what we are doing here is, for a very specific vertical, we are combining the advantages of the financial advantages of a good VC fund with innovation insights and innovation advantages of accelerator or incubator programs. But to be very clear, we do, for instance, we do not do projects. We don't do acceleration projects. We don't accelerate startups. We don't found internal startups. We don't do that. We do the matchmaking, but we are not like a accelerator program. We don't work with the teams in terms of we're accelerating them. We are also not event-driven or marketing-driven. So there are a lot of programs out there that do a good job. If you want to do in terms of brand recognition, you want to be associated with something innovative. So we do not have a strong marketing or publicity focus. The advantage is that if you have the return perspective of a good fund, that gives you, and we've heard that a few times, you don't come under pressure because you're profitable, your fund investment. The left-hand side here, the typical accelerators, often have the issue that when business of a corporate is going well and the focus is on innovation, there is a budget to come up with a new event. There's budget to ramp up a new accelerator program. Then when business is not going so well 2 or 3 years later, or more typical, there's a new CEO. The new CEO says, well, why do we do this? This is innovation theater, where's the return? And then often accelerator programs and stuff that have just started to gain traction and to generate impact are stopped. So that's something that we often see, that accelerator programs find it hard to justify their the costs because it's hard to prove their value. I think there is value, but it's hard to measure it. So here, if you combine the financial strength of a fund with innovation insights and innovation return of an accelerator program, that's a good value proposition for a corporate. So how does that work specifically from a corporate investor point of view? Now, if you look at the right-hand side, this is the expectation of a financial investor. Yeah? You invest in a fund, and the fund gives you a great financial return. That's what a financial investor expects of a fund investment, and that's what we do. Yeah? So this is, let's say, from the corporate side, your CFO would look at us that way. The CFO looks at how much flows in and how much comes back in terms of financial invest. On the left-hand side, on the bottom, you see what we do on top, and that is we discuss, we collaborate with the other functions, and this is, of course, a simplification. So that means we're also interested in engaging with the CTO, because we look at the same domain the CTO looks. We look at a certain technology, and we tell the CTO, because we know what's on his or her agenda, we say, look, here are the top 5 startups that we've seen that you should know about, because I know that's on your innovation agenda. And then we discuss it with the CTO. And the CTO says, hopefully, oh, I didn't know about these 2 startups. Oh, that startup I knew, but I didn't know they had overcome this one issue. And we, in return, get some deep technical and market understanding in return. So we get the feedback. So what do they think? People that really know about technology and markets, What do they think about it? And now here's the important bit, because corporate investors and corporates sometimes have a bad reputation. No, we don't ask the CTO if we should invest in that startup. We don't do that. But we ask him or her about the technology, about the market, about him or her as a potential customer. Would you work with that startup? Would you buy their technology? And that's a proof point for us, and that helps and makes our technical due diligence better. And it gives in return other corporate function very specific value from a fund collaboration than just the financial return. Same goes for the strategic side. And so you want to do, ideally, you as a fund speaking to the startup ecosystem, you can, from talking to 600 startups, you can boil it down to 6 trends that your LP is not aware of yet. And you're an independent. We had this discussion earlier on with Sean. You as an external fund, you can go to your LP if he or she wants that and say, look, these are the trends that we see. And here is the disruption that is looming around the corner. We can say that because we're independent. If you're the in-house innovation department or the innovation scout, it's always difficult if you contradict the department next door. Yeah. So we take the liberty to do that. And what's our role? It's also very, very important. Our role as a fund in respect to our corporate LPs is that we are the intersection. We are the connecting bit to the startup ecosystem out there. And that is important because it makes sense that a corporate that has a choice of setting up their own scouting unit with 3, 4, 5 people to cover Europe, that they say, we do not set up our own unit to do the external scouting. We leave that to the people that look at all the startups out there anyway. We focus on transforming and translating the startup ecosystem's system know-how into actionable projects internally, because that's something we do not do. So there's a clear divide between we are in charge of looking out there at the startup ecosystem, also understanding the needs of our corporate LPs, translating that into actionable insights for the corporates, but the corporates then translate that into projects they do. We do not do internal projects for them. Now, coming back, the basis of what I just presented to you was the learnings that we've seen over the past 15 years on what's going well in terms of the startup ecosystem, what is not going so well for corporate VCs. One thing that is of utmost importance to me is, for all of us, it's a journey. So I was with Siemens before. Siemens started to invest and work with startups early 90s. Apparently, I learned from Marcus today, even mid-80s. That was even before my time. But it's always been a journey, and it still is. So I know very few corporates that would claim, here's my setup. I found a solution on how to efficiently deal with startups, how to financially make good investments, and strategically collaborate perfectly with them. So it's a journey for all of us. And what I've shown you just there is a multi-corporate fund approach can be one solution for your issues. So here are some learnings. Learnings on how to win high-quality deals. Also some learnings how you can leverage a corporate to win a deal, and how to not only to win a deal, but also how to create value for a portfolio company. And this is a typical scenario, if you just stick to the right-hand side for a second. This is a typical scenario where many corporate VCs struggle with. You have financial experienced venture capital investors. They invest in a startup, but often they have very little interaction with the business units. Okay, and so in theory, it's always easy. Yes, we leverage our business units. To do that practically is very, very difficult. How do you do that? If you know how to do it, it can be a great asset. So I've seen a few deals where the startup at an early stage needed that first signal customer, corporate customer. You're an early stage startup. You have a great technology. No one knows you. You're in a B2B deep tech field. And there you would need the one bank everyone knows to work with and that accepts you as a customer. That would really be a game changer. Now, how about if your investor says, I don't not only give you money, but I will take care of that you will get, because I know your technology, I know your team, I know you're good, I will make sure you get the first signaling customer. That's a big, big value add. And from a corporate VC point of view, wouldn't it be fantastic if you invest in a company and at the same time your business unit becomes the first big customer? Yeah, so that's almost an ideal case. You increasingly, by becoming a customer, you immediately increase the value of your portfolio investment. I want to focus now on the left-hand side. Some learnings on how you create better value for your LPs. So this is always, keep in mind, I'm speaking now from a fund setup. So I'll give you an anecdote. We talked to a big German automotive OEM. We talked about a fund investment, and we were a bit hesitant, because we knew exceedingly complex. You talk to 40 people with 60 opinion, and you all know, of course, with your companies, it's all different. It was exceedingly difficult, and they explained to us, no, we can't do fund investments, and we don't have the mandate for that, and all that. After 3 months, they found out they had already done a fund investment. The company had invested in a fund, a significant amount. No one knew about it. The CFO, 3 generations ago, so that meant 3 years ago, there was a CFO who knew someone at a fund and decided, wouldn't it be great? Yeah, having heard a similar story probably to what I've been telling, heard a similar story, and the CFO said, we invest in that fund. So big automotive OEM invested in a fund, and no one knew about it. CFO changed position, and once a year, the new CFO would stumble across the fund investment, would say, oh, that's doing great. What is it? Oh, cool. Okay. Would put it aside. Nothing happened with it. So that means you really need to be very clear about how you collaborate with a fund and how you do that. Otherwise, it may be a good financial investment, but nothing happens. Most funds are happy with that. Most financial investors are happy if you, as an investor, give them money and show up once a year to have lunch, listen to the performance, and then you go back. Most funds are happy with that. We want to collaborate with our LPs. Most funds don't want to get interfered. We want our investors to talk about, discuss, and give us other opinions about the startups we see. That only works if you have a clear understanding that you do the investment decisions because you're the investment professional, but you understand there's value add in terms of market and technology understanding if you talk and listen to your LP. So my second anecdote, and we've heard that here as well. If you look, you have CVCs and venture client activities often disappoint financial expectations. Yes, we've heard that before. So you have a CVC, you have a venture client activity, you have an incubator, you have an accelerator, you have a venture studio model, and whatnot. And I think there are great approaches associated to that. You have the issue of proving the value and the return of it. In good times, the CEO says we need to go big and spends money. 2 years later, the CFO says, so what exactly has come out of that investment? How about the 5 million that I gave you, or the 10 million that I gave you? So what's the bottom line? So fund investment gives a return, can show just on the financial side, this is what you get out of it. And on top, there is a strategic value add that you may find difficult to demonstrate. So to wrap it up, we're a multi-corporate LP fund. It's a bit of a mouthful, with a clear vertical focus. And we only focus on LPs that are interested in that vertical. We are not a service provider. If you say e-commerce in Latin America, you're interested in, sorry, we can't help you there. We are backed by some large institutional investors, including the European Investment Fund, by some top corporates, all with a strategic but non-competitive interest in mobility. And we're also backed by scale-up founders, so experienced founders that now are seeking to get in touch with the next generation of early-stage startups. And we are going live this summer. And if any of you are interested, then feel free to reach out to me. And as a concluding statement, here are my 2 recommendations, just from having heard over the course of yesterday and today. The first one, very obvious. If you think about setting up some corporate venturing activity, keep the possibility in mind to invest in a fund, but have a clear understanding what the fund can provide and what you need to do yourself. If you think the fund can do everything for me, it will not work. If you think, better I do it all myself, and I get 3 people on board that do the scouting in Spain for me, it's probably not the wisest decision either. So think about if a fund investment can be part of your corporate venturing activity. The second, bit surprising, talk to your procurement department. How can you get, in terms of innovation, startups on board in an easy onboarding session? Most innovation projects are great, and then they fail to scale because they can't get past the procurement department. You do a great innovation project, and then you find out, well, the procurement department said we need 3 comparable solutions to compare. Sorry. So that's an easy victory, easy in terms of low-hanging fruit, still a lot of work. Get your procurement department on board to get innovative startups easily onboarded as suppliers. Thank you.
Thank you very much, Matthias.